Thanks for joining us. And yeah, so today we're specifically going to talk about buying a house, borrowing, and being self-employed, which most lenders will be like, nope, can't deal with you, go get a W-2. But, you know, in this day and age, I think a lot of the great resignation, you know, a lot of people who might have had jobs or just, you know, deciding to start their own business or people's businesses that have been kind of like a side hustle for the last 2 years, and the last couple of years maybe became their full-time gig. And I get a lot of clients. I have a lot of clients who are self-employed, and I just want people to know ahead of time, you know, it's not impossible, it's just different. And so Fiona Bryan is from Academy Mortgage. She's awesome, works with a lot of my clients, and is the type of person who says, how can we do this? She doesn't say we can't do it. If she says we can't do it, then you really know that you can't, because she'll try to find every way.
We can't do it right now.
Right now, exactly. She'll say, I can't do it right now, but we do X, Y, Z, and then we can get there. So Fiona Bryan from Academy Mortgage. I'm Sammy Lyon. I'm a realtor with Dow Capital. And yeah, so we're just going to talk a little bit about self-employed borrowing, and we'll try to keep the presentation part real short, and then it's just going to be Q&A, ask us anything. We have a lot of questions from the registrations, and at any point just feel free to throw your questions in the chat, and we'll just go as long as there's questions. So Fiona, take it away.
Awesome. So basically I didn't know this was going to go one at a time. We're going to actually do we're going to cover what does it look like for a self-employed borrower? What is the difference between a W-2 and a 1099, a Schedule C, whether you have a corporate structure, regardless of how you run your business, we're going to cover all of it, because it is entirely possible for you to own a home. And conventional lending gets a lot of marketing and a lot of media coverage. And the reality is that the government sponsored entities, the GSEs, are not the only lenders or insurers of mortgage backed securities. There are plenty of lenders and investors who see the value in lending to pretty much everybody who has a business. So we're going to cover conventional self-employed. We're going to cover some of the non-qualified mortgage self-employed borrowing. But essentially, my goal at the end of this is that you're going to have a pretty good idea that, I think I can borrow some money to buy a house, because honestly, I think pretty much there's a loan out there for everybody. That is kind of my philosophy. So buying a home can seem daunting, but I have a typo in there, but if you plan ahead and you know all of your mortgage options, particularly if you're self-employed, it doesn't have to be, right? So my goal and Sammy's goal is always education. We are very big on consumer education. Planning ahead, it is never too early to contact someone like myself or Sammy. 12 months, a year, to 2 years ahead of the time that you think you're going to buy a house is the perfect time to reach out to us. The reasons are that we don't know what we're dealing with until we see it. Until you actually have somebody take a look at your financial profile, there's no way for you to know or for me to know exactly what that's going to look like. And sometimes it could take us 6 months to get you where you need to be. So getting in touch with me a year ahead, or if your goal at any point in your life is to own a house, you need to be getting in touch with somebody who can give you some advice ahead of time. So, and, you know, working with the right team, essentially, I think the right team is me and Sammy. However, if you are currently working with somebody and they are teamed with somebody, then you're probably in good hands, because in this market, it is very important that you have a team on your side. So who plays a role in the home buying process? You do. You get to choose who you work with. As a real estate agent, you know, you will have the listing agent, who is the person who's representing the buyer of the home. You're going to have your buyer's agent, who you get to interview and choose, and then your lender. I highly recommend that you find a team. If your lender and your real estate agent are not teamed up yet, You need to introduce them. You need to find out how they work together and if they're going to be a match, because that team is the one that's marketing you. When you make offers on a home, it's not just your real estate agent that is sending in your offer. It is the lender who is also representing you as a borrower, as a solid borrower, telling the listing agent how they've pre-approved you, how qualified you are, and why they should choose you, because the loan is going to come through. At the end of the day, they just want to see the money on the table. And so that's why it's really, really important that you have a good team. I think Sammy and I are the best team out there, but I might be biased. As far as loan pre-qualification, I mean, there are some do's and don'ts, and we'll probably send out some communications after this workshop so that you can have some ongoing education. But the main things are always ask. Like, we are free to ask. There is no charge to call me up and ask me a question about lending, about what I'm going to look for as a lender, about what you need to be doing ahead of time. That is free. Like, I don't get paid until there's a loan out there, but my passion is making sure that consumers are educated and understand home buying. And so I lay the groundwork well ahead of before you buy the house. So that's kind of how that works. So call us. I think there's a lot of things to do. You want to make sure that you have stable income, that you can, if you've been running your business, and we're coming out of COVID, there's a lot of letters of explanation. And that is essentially a letter to the underwriter that explains things that have happened in your business in the last year or so. Letters of explanation regarding COVID are very common. And there are a lot of reasons to look at your business and its history versus the years of COVID. And so having somebody who can help coach you through those letters, help you present to an underwriter, super important. You definitely don't want to make any big changes. And if you do, you want to talk to the people who are representing you before you make them. So, no major purchases. You don't want to go buy a car. If you're going to buy a car and it's necessary to do it, let's figure out how to make that happen. Don't move a lot of money around, things like that. So I just always like to throw that in there, because life happens. And then when you're trying to buy a house, you need to control the life. Simply said. Okay, so the self-employed borrower. I, at heart, am an entrepreneur. I always have been. I work for a company now. I'm actually a W-2 employee, strangely enough, but I run my business. And as a loan officer, I am running a business. However, I do also come from a background of 1099 and also having an LLC structure. I understand how the self-employed borrower thinks. I understand how you do your taxes. There's a lot of benefits to being self-employed. And my goal is to help you continue to get those benefits and still be able to qualify to purchase a home. And there's a bunch of different ways to do that. Essentially, for conventional lending, that means if you want to get a loan with the typical loan that you hear advertised every day on the internet, on the radio, wherever you see loans advertised, they're advertising what we call a conventional loan. The FHA and the VA lending kind of falls into that category as well. So the types of things that we're going to be looking at is your most recent 2 years of personal and corporate taxes, if you have a corporate structure, the schedules, any other documentation related to your business. If you're a 1099 contractor, that is self-employed income. If you have a partnership, you'll have a K-1. You may actually have a C corporation where you're paying yourself a W-2. That still has to tie back to the corporate taxes. So those are the kinds of things that we're going to be looking at. We always want to know where you've lived for the past 2 years. We want to know about your outstanding credit and debts. If you have student loans, there are a lot of different ways that those are accounted for by different lenders. The last 2 months of bank statements. We want to see that your business is continuing to do the type of business that you are recording in your taxes. Information about your real estate and personal properties. So anything that you have owned that is real estate related or you own now is going to be, it's going to come up in a search. If you owned a property and you sold it a year ago, we may actually just need to kind of check in on that and see, do you actually still own it? Is there a debt still associated with it? Has it been made whole? As far as self-employed borrowers specifically, there are a few things that we may ask for. And we can talk about how to prepare for these things. A year-to-date profit and loss statement, a CPA letter, if you have somebody who prepares your taxes, somebody who can confirm the length of time you've been in business and that you are, and what percentage of ownership you have in that. And we may also ask for a business license, because if you've owned your business for more than 5 years, we may actually only take a look at 1 year of business income. Traditionally, we're going to look at 2 years and we're going to average it. But if you've been in business for 5 years, we might just look at 1 year. And it is actually up to underwriters' discretion. But gathering all that information is my job, because my job is to put you in the best light of the underwriter so that we can get the best possible scenario. Now, what if my taxes don't show enough income? One of the benefits of being a self-employed borrower is that you can write off pretty much everything. You can write off your car if you're working from home. Your taxes and your net income may not actually reflect the type of business that you're doing. And so there are types of loans that are called non-qualified mortgage loans. Those are loans that are done by private investors. They're not insured by Fannie Mae or Freddie Mac, who are the government secured entities, right? So the stuff that you hear advertised every day on the internet, on the radio, that kind of stuff, those lenders are insured by government-backed, federally regulated organizations. The non-QM loans are all private investor. The rates are more stable. They will go more risky. You as a business owner may be making more than the average person on a W-2 income. And the conservative view of Fannie Mae or Freddie Mac may not allow you to borrow the same amount of money that a private investor may. They're going to see the value in the risk of lending to you. And so those types of loans, the most common one is a bank statement loan. And in that case, we take a look at between 12 and 24 months of deposits into your bank account, your business bank account. And every deposit is considered income. Some will be backed out if they are not business related. And again, that's at underwriter discretion. They kind of take a look at your type of business. They have a whole year to 2 years view of the type of income you're taking in. And so they're going to come up with a monthly income. And oftentimes I see people who come up with a qualifying income almost twice what they would with a conventional loan. So it's a very, very good option for many, many businesses, particularly those who run on a cash basis, people who have hairstylists, beauty salons. If you own your own business that is primarily cash or on a daily basis taking in cash, those types of businesses are going to be a great option for this bank statement. The interest rate is oftentimes, well, it's been a very chaotic couple of months, but the interest rate is very stable. I would say that recently they have been about a 1/4 point higher. In the past, they've been about a point higher. So we're starting to see the non-qualified mortgages and the qualified mortgages kind of come together, because all of a sudden, we've got a situation, which is a whole nother presentation, but we've got a situation where our conventional loan rates are getting higher and higher. The market that the non-qualified loan is based on is completely different from the mortgage-backed securities. So those rates are not so bad, especially if you consider the amount of money that you save on taxes. So the conversation with that type of borrower is, if we want to prepare you to purchase a home, you can work with your tax professional to set that up so that it looks really good in the 2 years around when you're going to buy a house. but does that expense make sense? So that's kind of some of the stuff that I look at with people. P&L loans, that's your profit and loss statement. If you've been in business and you maybe are only taking in large chunks of money for specific contracts, we may want to take it just a larger view at that picture. A higher risk, higher interest rate. Asset depletion loans, those are, you're based on the depleting asset portfolio. There's a formula that we use that essentially will deplete your assets over a 30-year period. If it works, you qualify for the loan. And that really is for people who have large asset base. The DSCR, this is for investors. This is a non-owner occupied home only. This is something that I would love to chat with anybody who has interest about, but it's not really something that I think most of us are looking at tonight, because I think a lot of us are looking at purchasing homes for ourselves. In terms of what underwriters look at, now there are different corporate structures. If you have an LLC, a C Corp, an S Corp, those are all going to be looked at differently, but there are calculations and they essentially are looking at what your net income is. And there are a lot of things that you're going to be allowed to deduct that will deplete your income. And that's where the non-qualified mortgage can be handy. What I really encourage you to do is have somebody review your taxes over the last 2 years, and they will tell you exactly which direction. I can tell in probably 5 minutes exactly where somebody should go, what they should do, and then we can have a discussion about what needs to happen if they want to go in one direction or another. It's usually pretty self-evident, and once I explain it, it usually makes a lot of sense. So an underwriter is looking for, can you repay the loan? That's why bank statement loans actually work, because if we see that there's money coming in and we know that your expense ratio is not that high, regardless of what you put on your taxes, we know you can repay the loan. Your willingness to repay the loan, that's your credit. Do you have a good credit score? Now, that can vary. A good credit score can have a past history that has a few blips in it, but we can explain those, right? The letter of explanation comes back into play. The collateral, the property that you are purchasing, is it value? What's the value of that? Does it fit the value? And that's a conversation that is coming into play quite often recently. Sorry, I'm going through. So those are the main things an underwriter is looking for. Nothing to be afraid of. If you are a business owner and you are earning money, there are ways that we can show an underwriter that you are worth the risk of a loan. Okay. I don't usually talk this long, so I feel like this is a very heavy topic, right, Sammy? Usually we're like 10 minutes and then we're into conversation. We're going 7:22. Okay, so a few easy tips. Now, number one, please just call, because the fastest way to help you is to just give you an overview of what we're looking at when we look at your specific taxes. There's so many different corporate structures. There's so many different ways that you run. If you have a Schedule C versus, some people are actually living off of Schedule E, which, Sammy is kind of headed that way, and then moving to an LLC because of investment properties. So many different ways to look at this. But the main thing is your bookkeeping. Keep books, keep an accounting. It does not have to be fancy. It can be an Excel spreadsheet. Just keep it, because then when you have to show us something, I can show you how to pull it. A profit and loss statement, that is a huge thing. A lender wants to see a year-to-date profit and loss statement. We want to see, now, when you file taxes in 2020 and 2021, we're now in April of 2022. Are you on track to make the same, more or less? Or do we have declining income? That kind of thing. That's what we're looking for with that profit and loss statement. And it does not have to be audited, not always. We just want to see, because we're going to be able to look at your bank statements and tell if that's accurate. Taxes. If you have a complicated business, or you're starting to get to the point where your business is very busy and you're not sure how best to pay your taxes, consult a tax professional, a CPA. Let them know that homeownership is a goal, and let them talk to your mortgage professional to determine whether paying more taxes makes sense or going in a different direction makes sense. So, and at the end of the day, just get started. Just get started. Like, don't think I'm going to do this in a couple of years. Talk to us today, because a couple of years from now, you're going to be starting from exactly where we're talking about right now. And we may have to kind of arrange things and wait for 2 years. 2 years in the life of a business is exactly how much time we need to determine whether you're going to be able to be qualified for a loan. Whether it's a non-qualified mortgage or a conventional loan, you have to be in business for yourself for 2 years. That is just kind of one of the main things. Oh, and this picture on the right side here, this is my sort of sketchy, this is down and dirty. I mean, this is what a cash flow looks like from a business. For this person is January through July. So you can see literally all we're looking for is how much money has come in, how much money has gone out. Does not have to be a fancy program at all. And state of the market, where are interest rates going? Okay, interest rates are a lot of hype. The market goes with expectation. The reason rates have gone up is because we are expecting a lot of stuff to happen with the Fed. We saw a lot of chaos in the last couple of weeks with rates going up, but a lot of that was already built into the market because of news and media and all that kind of crazy stuff. So yes, rates are going up. They're probably going to go up for a little bit. We are likely due for a recession. Housing does very well in a recession. Rates come down in a recession. So if you were to buy a house today and you felt like you were paying this crazy rate, which is also still at a record low historically, you would be able to refinance. So as far as rates, I think at the end of the day, my strong piece of advice is that stop looking at rates. Look at what your income is, look at what you can afford on a monthly basis, look at what's comfortable for you. You're not buying a rate and you're not buying a price point for a house. You are literally settling into a monthly payment. That monthly payment will stay stable for as long as you want. Your rent may continue to go up, but your monthly payment on a mortgage will continue. So it's a great way to stave off inflation. And then the other piece of that is that you have an asset that's appreciating. You will always be putting money into something that you own rather into something that you don't own. So that was a lot of words. I'm going to hand it off to Sammy on what's happening in the LA market for housing.
Being deep into it, and then we can, talk more about specific questions people have. But yeah, people ask all the time, is it a good time to buy? I'm like, well, if it's a good time for you, then it's a good time to buy. Because I know we all wish we had bought in 2010, but it wasn't a good time for me. Like, I just didn't have the income. I didn't have it wasn't right. And so too bad. So it's like when you're ready to buy is when it works. And I think specifically what Fiona has taught me is you need to just focus on the monthly payment. There's more than just like, I know you can go online and just like find, the lowest rate from some online company, whatever, not to mention all the piece about, the lender and the realtor team, like really marketing you as a buyer to the listing agent. I mean, I've gotten offers accepted that weren't the highest offer because we called and talked to them and the listing agent was like, oh, they know what they're doing. They're going to close. Let's go with them. Even though this isn't the highest offer, it is the best offer, right? So don't underestimate like the importance of that team. but also just like the rate, like the obsession with interest rates, like 0.25%, 0.5. It's like, that's not, I'm learning that there's so many more ways to structure the deal that focus on the monthly payment. So you're not really focused on the house price, you're not focused on the interest rate, but you're focused on what's your monthly going to be. And is that a number that works for you? And so you can buy down the interest rate, you can prepay the private mortgage insurance, you can, I mean, there's just so many ways. You could put less down, more down, you can change things during escrow to make sure you are getting the best deal and the best payment. So it's sort of like a floating target, and that's where we want to land. So
and I would say, I think that the value in what we have to offer is that flexibility, because because lending and purchasing real estate is not one dimensional. When you get your pre-approval today, it's not a flat number, it's a range. And not only that, if you come to me and you say, oh my God, I'm going to die if I don't get this house, and it's just a tiny bit more than what we've talked about, you know what I'm going to go do? I'm going to go figure out how to make that work. And if it's comfortable enough, you're going to get into it. Right. So it's just, I've seen it over and over again recently. And I think that you can't look at any of this as a one-dimensional, I qualify for this, I'm buying X dollar amount. And I think I love the back and forth. Sammy and I, you know, we're going to go look at this. I think it's going to go for X. And I'm like, ooh, I don't know. But, you know, I mean, I love a good challenge.
I know. I think both of us are kind of like into the challenge of, okay, what can we get done? And both Fiona and I actually have, like, we have nonprofit backgrounds. Like, we didn't, you know, grow up in this industry. And so these are both of us, this is a career change. And so, you know, I used to be a teacher, and you wouldn't really think there's that much parallel, but it is. It's like you could teach the same lesson, but with different people. It's a different year. Like, it's always changing. And so that's what I like about real estate.
Well,
it's
and what greater way to give back and create community and I mean, just help people. This is the biggest investment of your entire life. You deserve this to be exactly what it's supposed to be. And that, for me, that's kind of where I always come back to. I mean, I never imagined that it would be as rewarding. But yeah, it's not about the purchase price. It's not about the loan size. It literally is about the puzzle and how this works for you in your life. And the other piece that I love too, Sammy, there's this whole sort of forward-looking thing. Like this may not be your forever home. And oftentimes right now, people are trying to wait. And my message is just get into the market, because the people that you are looking at and saying, oh my God, if I'd only done this 6 months ago, like, you probably could have. Most people don't realize that there is an entry. It might not be 100% of what you expect, but there's a place to enter. And once you enter, then you have a spot at the table. You have a spot at the table and a place to play from.
I mean, yeah, I think with real estate, you know, whatever, the best time to buy was 10 years ago, and the second best time is now. It's like, if you're ready, you get in the game. And you know, don't get into a pressure scenario, right? There was just the Zillow survey that like 75% of people who bought during the pandemic, you know, regret some aspect of it. And I was reading, you know, things they regret, like they waived their inspection contingency and the house is a complete disaster. And I'm like, who advised you to waive your inspection contingency? That is like such irresponsible, you know, realtorship.
And it's also because the mathematics behind what you qualify for are very different from what you feel comfortable with.
Right.
So if nobody sits and tells you like, oh, well, this is what you're telling me you feel comfortable with, and this is where you know, I mean, like, look, a lender is going to lend you as much as they can qualify you for.
Yeah,
That may
sure.
not at the end of the day allow
Be
you to
good for
still go to
you.
the movies and have dinner out once a week, you
Right.
know?
Yeah. No,
Yeah.
and that was another regret. People paid more than they thought, right? I mean, we have clients who qualify for like $1 million and we're looking in like 600 to 700. And that's what works for them in terms of a monthly payment. And like neither of us have any interest in pushing anyone beyond what's comfortable for them, because that's not how you get in. We want you to get in the game, but we want you to get into it responsibly. And I think real estate people think is risky, but I actually think with knowledge and with the right team, all you really have to do is understand what the risks are and then figure out the ways to mitigate those risks. And that's how I was like a teacher I started buying out of state investment property that I had never seen before, which sounds ridiculous, right?
Still sounds ridiculous to me.
But I found ways I learned all about insurance, about lending, about what could go wrong, how to, hiring a good inspector, like all those things. I built a team, so for me, it was all about mitigating risk. So in my opinion, inventory is low. That means that a lot of people are, fighting for the same house. If that house, if you make an offer that works for you and you get the house, amazing. If you get outbid, it means that you weren't supposed to get that house because it went for higher than you would have felt comfortable for. So I guess to me, it's like, well, then that wasn't going to be the house you were going to get, because if it goes over what you wanted to pay, then
value is
have that house.
Yeah.
Right. So to me, it's like you will find a house that you like. And I think being persistent, just consistent and persistent. So anyway, pep talk aside. But I do think that it's sort of like I've been thinking a lot about real estate recently as like you're just like doing push-ups, right? Like if you did 10 push-ups a day for
no shortcuts.
a year, that's going to get you somewhere versus like I did 500 push-ups today and then no more. That's just not how it works. Like you're going to be persistent. And then I think once you get into the real estate game, you are monthly paying down your mortgage, right? So like over the course of 30 years, and hopefully you're paying it down sooner, doing a couple extra payments, stuff like that, but you are now, your equity is so high, even if the market didn't appreciate at all, which over 30 years, it will, you have now built that equity versus, paying your landlord's mortgage. So that's kind of interest rates in the 80s were like 11%, 14%. People were still buying. So I'm just sort of like, we're in this weird space where we've seen the lowest interest rates ever.
And they're so we still at record
5%
low.
is high. Yeah. So
yeah.
Anyway.
Yeah.
We do have some questions.
Yay.
And so, yeah, feel free. You can either unmute yourself or you can throw your question in the chat, but I'll just start. How do lenders view real estate income from past properties? Do they look at gross rents or only the taxable income?
Okay, so a realtor, if you currently own the property and you want to count the income, we have to see a Schedule E. If you've owned the property for 2 years, we want to see a 2-year history. If it's a recent purchase, we definitely want to see a lease. We like to see the Schedule E because, again, you can look at real estate property income almost as self-employed income. We still want to see, what are you deducting? Because if you have a lot of expenses or your mortgage is much higher than the rent, we want to know, what are we going to look at? So typically in the lender world, we apply a 75% occupancy ratio. So we're looking at probably 25% of your annual of your annual net is what we're going to look at for real estate income. Conventionally,
Cool.
if you use a different type of loan, then no.
Okay.
Completely different ballgame. Then we just take the lease.
Right. Wait till you start owning property. They're going to want the insurance, the mortgage. They're going to want to look at everything. But, you know, ultimately, for a lot of people, buying your home that you live in might be your first property. But theoretically, you can just keep buying property. Then you become an investor, you know, unless you're selling that and moving.
And
but
there
if
are
you're
ways
just
to scale that. Yeah.
Yeah. So, okay, we have a question. I make between 8 to 12K as a consultant, but I've only been consulting since September when I quit my job. Every lender I talk to says I need a W-2. I'm renting to own my house and I want to buy. What are my options?
Okay, so they've been working since how long?
September.
September.
So like 6 months.
So
4 months.
the sort of hard and fast on self-employed is 2 years history. Caveat, if you were moonlighting prior and you have a Schedule C, we can chat. If you've been in business for 12 months and we can make a case for it, it's the same industry, the same business, same line of business, we can make a case for it. So that's the other thing about me that's different from sort of like don't go to a big bank. Don't go to the big banks. They're very conservative. If you find a lender that can find value in your risk, then you're more likely to get a loan. So I would say if you have 12 months and a history in that industry, then we can probably count your 1099 or self-employed income. Yeah.
And what's good about like not waiting till the 12-month mark, but you know, having like a 6-month run up is the lender can, you know, give you some advice and be like, oh, okay, this is kind of where I'm seeing your income. If this is where you're at,
yeah.
If this is where you continue to be, then this is the number.
Yeah.
And then you kind of have like I mean, I'm a very goal-oriented person. So it just helps me be like, oh, I'm not just, you know, haphazardly running my business or saving for some unspecified amount down payment, but like, oh, in 6 months, if I, you know, save this much and keep making this much, then this is what I can do.
Yeah, we want to see a history of stability, and stable income is very big in the lending world. And so if you have stable income that, you know, was W-2 and turned to 1099, or even you're just, you know, self-employed, we can make a case for that, right? So underwriters have buckets they have to check off. If we can pull them out of the bucket and give them a reason to take a look at it, and they can get approval from somebody above them, then we can usually make it work. So,
right.
Especially right now, because there are so many people who are going out on their own.
Right. Yeah, like you were saying, moonlighting, like what if you do have tax returns business for yourself, you know, longer than 2 years, but like it used to kind of just be like a side hustle.
Yeah.
And in the last year,
I see it all the time right now, particularly people who are doing independent counseling, independent teaching. They've been maybe doing 10, 20 hours a week of tutoring, or they've been working for a nonprofit sort of like 30 hours a week and then kind of doing their own thing 10 hours a week. Now, the thing that really stinks is that we have to, you know, once you get past that 12-year mark, we're kind of still averaging your income. So we don't have a huge history, but if you've been in the business, we have a case, we can make a case. Not in every case we can make a case, but it definitely, it's worth a shot. And not only that, but at least you start having the conversation with somebody who can get you into a home. Yeah. Or find an alternative solution.
Okay, we have another question.
Sophia has a question she wants to ask.
Oh, please. Sorry.
So for the private loans, you said that you could do a bank statement loan where they'll look at 12 to 24 months of your bank statements. If I'm in a partnership business, do they look at the income into the bank, the percentage of my partnership, or is all that money counted as my income in the bank?
So do you have a corporate structure?
We're just a partnership. No, not corporate.
So how do you guys do your taxes?
I get a K1.
Okay, so that's a partnership.
Okay,
so
yeah.
You probably have an S corp, and that K1 will say what percentage of ownership you have in the company. And so we'll take I assume it's 50%. So we would do 50%.
Got it. Okay.
50% of a K1 or 50% of ownership. And the way that we would establish the ownership is that your CPA or whoever does your taxes would basically just confirm what percentage of ownership you have.
Okay, perfect. Thank you.
Yeah.
Awesome. Yeah, there was a question, other than a K1, what documents do I need to prove my income since it's not consistent each year?
So the consistent piece of it, we're okay. If you're using bank statement income, very different. If we're just talking about traditional conventional lending, you're going to need 2 years of taxes, both personal and corporate. And so the K1s are going to count. And if my understanding of the question is that the income from 1 year to the next is not consistent, if we see declining income, we would like to see an explanation. And that explanation probably is going to have to be something like, oh, COVID happened, and now I can show you, we can see from your P&L that business has picked up again. We need to show a case for why you are a risk. I mean, lending is all risk-based. How much of a risk are you? Your rate is based on risk. And that even in traditional conventional lending, that's why your credit score is so important.
Right.
That's why the amount of debt you have, your debt to income ratio is important. Lending is all risk-based. And so if we are going to take a look at your personal self-employment, if your income is declining, we have to be able to explain it, even to get it to qualify. And we have to show that it likely either has the ability to sustain where it is or to come back.
All right, we have a question. How to invest as a self-employed? How to invest with 6 months job history, which we talked about a little bit, and finding a rehab loan.
Everybody wants a deal.
I think actually the person who asked this is here. So find a rehab loan less than 100K based on the rehab market value. So investing, and then also a loan to do the renovations on the property.
Do you want to address if that exists?
Yeah, can you do it?
And can I do it? If you find the property, you get an offer for me? Sure, I can do it.
Oh, yeah.
If that exists, I can loan on it.
A property that needs renovation, yeah. I mean, yeah, there are. It's just it's competitive. Everybody wants to be a flipper these days. House, HGTV.
Yeah.
So,
I mean, in terms of investor lending, I mean, I kind of touched on it, and that's probably like a whole other webinar. But whoever that person is, if you reach out to me, I can talk to you about how to do investment lending. And in terms of like, if you don't have a ton of self-employed experience, but you want to get into the investor market, like that's the easiest thing ever, because like I mentioned, we have the debt service ratio loans, and essentially those loans, we qualify you based on what the rental income is. The fair market rental appraisal is what you're going to qualify on. Now, those loans, you're probably going to need to be at 20 to 25% down in order to make them work. It just, you can do an FHA loan, but we would have to be able to income qualify you for it. And the FHA loan would be 3.5% down, but most of those DSCR loans, unless you have between 20 and 25%, most of them don't make sense. Caveat, short-term rentals right now are a hot sort of trendy thing in the lending world, because forever we could not lend on them and now we can. And really the only difference is it's a higher interest rate because it's higher risk. So, but we are doing the short-term rentals now. So if you want to buy in Big Bear or Joshua Tree, we can make that happen.
Good luck there too. No, it's possible, but there was a question that I think, you know, some of these are a little bit vague, but I think the concept, like how much do loan officers want to see in regards to assets and income to qualify? What's a good amount for a down payment?
Very good question. So I'm a less is more kind of person. We only want to show what we need. Oftentimes we don't need reserves in order to qualify. So if, you know, having to provide 401k and all that kind of stuff, if we're not using those accounts in the transaction, I'm usually going to advise you to hold those back. Now, if I get into a situation where I'm like, you know, we probably need to show a little more strength in this file, I may ask you for more assets. But typically what we want to see is your source of funds. We want to see that you have your income is coming in regularly, that you don't have like large cash deposits that we can't explain. We do have a fiduciary responsibility to basically keep an eye out for and flag any kind of money laundering, drug trafficking, things like that. That is a responsibility. And so we are going to scrutinize your bank accounts. So the ones that you do submit, you want to make sure that you can explain all the different deposits. Now, a lot of times it could be like, hey, I'm getting a gift from so-and-so, or I loaned so-and-so money, and we just write a letter of explanation for that. But in terms of what we want to see, I only want to see the accounts that are going to be involved in the transaction. Mm-hmm.
Yeah, I'm telling you not to submit your money laundering account. So.
Yes. Hold back the money laundering.
And then what's
trafficking drugs, definitely don't.
Yeah, don't send them to Fiona. And then in terms of like, what's a good down payment, right? So we had the investor question, 20-25%, but like if, you know, owner occupant, self-employed, like what's kind of the down payment you're looking for?
So for an owner occupied primary residence, whether it's a first time or not, I think it's a very personal discussion. How much cash do I have? How much cash do I want to put down? When I'm looking at homes, do I want to hold back a little bit because I might want to redo the bathroom? Like that's where the flexibility comes from. That's where working with somebody who can run numbers with you and show you a variety of different ways of working with the cash you have available, that's where the value lies. Because you can put between 3 and 5% down as a first-time home buyer. As a anytime home buyer, you can also put 3 to 5% down. But it's at the end of the day, the less money you put down, the higher your monthly payment is. So if you have a lot of cash, we need to have a discussion. How much do you want to invest in this property? What is your, like, where else are you going to spend your cash? Is it better in the stock market right now? Is it better in cash? Probably not. Is it better in a home? Is it like, that's the personal discussion. And if you're working with a financial advisor, that's where I can interact with them. If you're working with a CPA and your taxes, that's where you need the team, because there's so many different variables of how you can decide how much cash you're going to put down. If you have between $20,000 and $50,000, you can purchase a home. Now, it varies on what type of home you're going to buy, but you can own a home. And even less, there are homes, there are actually programs where we can do down payment assistance and things like that. So again, another conversation, but the conversation between you and I becomes like, what's our long-term strategy? Like, what are our goals? Do we want to put X amount into a home now because we want to get into a school district, or are we buying into just get into the market? Then maybe the kitchen has to be redone. I mean, there's so many things. And I think that that's where running scenarios comes into play, is that it's a puzzle. You don't have to put all your cash down. You can hold some back. As long as you can income qualify and it feels comfortable, then it works. That's my philosophy.
And then specifically, how much do I need down for a duplex if you're buying a duplex instead of a single family house?
For conventional lending, if you're going to live in the duplex, you can do an FHA at 3.5% down. We can account for the other side's income in order to qualify, the rental income. So that's one. Now, it's very hard in this market to purchase with an FHA loan in many, many areas. So if you have 25% down, you can do a conventional loan. I do have, again, between 10 and 25% down investor loans. It's, you really got to live in it to make it worth it at that point.
Yeah. And just in LA, it just is harder to find a duplex that has a vacant unit just because of rent control, and generally, if there's a vacant unit, the price is higher. So, but it is possible. And so you could do FHA 3.5% or 10 to 25%, but you're not necessarily putting like 3 or 5% down if it's a duplex versus like single family. You have a lot more flexibility.
Yeah. And the other thing about in LA County, SB 9 and a lot of the regulations. And I mean, there are some areas that still have very large lots and the ability to build ADU and accessory dwelling units, which is another webinar. But I mean, there are ways to maximize those types of properties. But I think in terms of, you talk about house hacking and things like that, it's it is a very individual thing. And I would encourage anybody to really just reach out and sort of have a consult on what your financial situation is specifically individually, because that's really the best way that we can help, I think.
Yeah, it's all very case by case. The question, why is it hard to purchase with an FHA loan? Unfortunately, this is just a, I see it as just like a discrimination in the market, essentially. Like, I think that, real estate has an ugly history of like racism and classism and discrimination. And so, now it's all like fair housing, which obviously is a great thing, but is not necessarily implemented 100%. And the lending is supposed to be, fair and not discriminatory, but essentially, I mean, it's really like misconception that an FHA loan means that you're not well qualified, you're not putting a lot down. So essentially, if a seller has an offer, we made an offer on a house for $600,000. There's a conventional one with 20% down, and there's an FHA one with 3.5% down. Generally, the listing agent or the seller will, advise the seller to take the one with 20% down, because it's like, well, they're more qualified and, they have more cash, which in a way, there's some truth, because with more cash, you have a little bit more flexibility. But the FHA loan could be, you could be very well qualified.
I will say a lot of it, again, comes down to listing agent education.
Yeah.
Agents hear stuff and there's a lot of myth out there. The FHA requires a certain amount of safety in a property when they do an appraisal. And so what has happened over time is that there's this myth that you're going to have to pay a ton of repairs and blah, blah, blah.
Right.
Well, honestly, anything that FHA is going to require is absolutely going to be flagged on any inspection that you do. And
Right.
so it essentially formalizes all of the standard things that you should expect as a home buyer. In this market, there are a lot of people who are willing to let those go by the wayside, and that's why it's kind of become an issue. However, I will say, if you have an FHA loan, if you have a VA loan, that's where having a team and having people who can position your offer appropriately comes into play, because there are ways of heading off especially with VA. Hey, termite is a huge thing with VA. We up front will say to the listing agent, we're making our offer, it's going to be $2,500 higher, because on average, that's what we ask for termite. And we are willing to go X dollars amount above the highest bid. And so just because you're using a specific loan program does not mean that you can't provide the seller the same amount of value and the same bottom line dollar that they would get any other time. It's just, it's an extra step for your representation for us,
Yeah.
But that's, I'm passionate about doing that,
Yeah, just the misconception and just talking to them about it. I mean, I see, as a realtor, I see like the private remarks that on a listing, and it'll say like no FHA. I mean, and if I have a client who has FHA, right, which I was like, okay, first, but I'll call and I'll be like, why? Like, so what's, is there? And they're like, oh, it has termites. And I'm like, so like every house in California has termites, like we'll deal with that. That's not a deal breaker on an FHA loan, but that's like, I mean, I have ones that say like, it won't qualify for lending at all. I'm like, what? Why are you saying that? Like cash only. So I think part of it is
not true, because there are so many different loans that will do sticks. Yeah.
Right. And I have a deal right now where like there's repairs needed to the basement, and the appraiser and the lender have called that out and said like, okay, this needs to get fixed before close, right? And it's not an FHA loan. It's just like what Fiona was saying, like it's just that it needs repairs.
Buying a house, you have a common set of expectations.
Yeah. So I think that's, you touched on a question that I think we're passionate about, which is like, obviously if you can do a conventional loan for those reasons, we would say, okay, let's find a way to do that. But for some scenarios, it makes the most sense to do FHA or a VA loan. And then really it's our job to educate them. There is actually one, just as we were talking about it, there is one instance where an FHA loan is not good, which is there is a 90-day sale rule. So I am seeing a lot of flipped houses. There's investors out there buying houses off market and then renovating them and selling them. And as a first-time home buyer, I mean, I know you could be like, oh, I don't want to, they made money off of it. And it's like, well, they fixed it up and you get to just move right in and, it's nicely renovated. So it's a flip. And if it happens quickly, which some of these, they like bought it and a month later it's on the market, totally renovated.
We had one recently.
Yeah.
And that was actually flagged. Yeah.
Has a 90-day rule. And that's come up before where I had to extend the escrow. We just waited. We were in escrow for like 90 days, just waiting for that day to happen so that it could close. So I think there is one instance where the FHA, could be an issue, but we would deal with that. That's not an issue. That's not really an issue, but it's just something to
very
think about.
Sad for the loan officer who did the original loan. Their commission gets recalled.
Oh yeah.
Yeah. Just FYI, if you don't
Well,
plan on
the
being somewhere for
flippers
6
are,
months, don't do it.
yeah, that's true. The flippers are using whole different lines of credit and stuff
Yeah.
too. So,
Yeah.
and then there's a question, last question, I guess, is just like, I want to invest in real estate and buy a house and figure out the best way to do both. I mean, one thing that we're interested in is like helping you in all of your real estate transactions and goals, not just the first one. And so do you have any thoughts on like strategically, you know, someone who wants to live in a house but also do investments, like what's the best way to go about that?
Yeah, so a lot of it comes down to expectation and where you want to live and what you want, right? So if you, for investment purposes, cash is always going to be king. If you're owner occupying, it's always going to be a little bit easier to get into the loan, which is why people do the 90-day flip thing. But so I think if you have a certain amount of cash and you have a plan, coming up with a strategy makes sense, because there are actually a lot of grant and bond programs that are designed around owner occupied home ownership, and they will definitely, you know, assist you with either a forgivable grant in some cases or with down payment assistance. They're not always the cheapest, but if you have a specific strategy to use your cash in a certain way, it could be quite brilliant. But what I would do is keep in mind that if you want to become a real estate investor, investors are always looking to make sure you have a primary residence that you own. And that is becoming more and more of a sticking point. If you do not own your own home and you want to buy an investment property, it might be best to kind of do whatever you can. You can still conserve that cash. We can still conserve that cash, but you really probably need to own your own home before you can start investing in other properties. And that's why house hacking actually makes sense. But more and more investing lenders, they want to see that you own your own house that you're living in. They don't want to see you renting.
Interesting. I didn't know that actually.
It's in the last year, Sammy, it's become a huge sticking point, because I have some very, very good regular investors that are like, their family culture is that they live multi-generational. And so he's been living with his family until he gets married. And the Southeast Asian families, it's very common. A lot of Mexican families, it's very common. And we've actually written letters saying that this is a cultural thing and gotten exceptions for it. But it's been a huge push, because these people are living with their parents in order to invest in property. The investors don't like it. They want you to own your own property. They want to see that you are also taking care of your own personal primary residence. Yeah.
Lending.
There's a way around everything.
Rife with discrimination. So
it is. Well, I actually just got an exception for somebody who retired and is touring the country in an RV. We use the RV.
Zoom glitch.
It works. I mean, listen, I'm telling you, if there's, I will find a way.
You use the RV as
I did. I did. I presented them with the RV lease, or it was actually a loan. I presented them with the RV loan. I said, here's her housing expense. Here's her monthly gas cost. And they accepted it.
Again,
I don't know.
Can't do it. How can we do it? So, well, that, if we don't have any more questions, that was kind of thanks for sticking with us. But ultimately, you know, feel free to reach out to us. Obviously, both of us are happy to talk about this endlessly. And for every question, there is a scenario, and that's what makes it fun, and just putting the puzzle pieces together. So all I would say is, do not be discouraged. It is possible. It's just figuring out the way there. And so, feel free to call us anytime. We'll be sending out this recording So you have it as well, and you can touch base with us whenever you
And
want.
I put my email and my phone number in the chat. If you guys want to set up a consultation time, I'm happy to take a look at any of your documents. Sometimes the self-employed income takes a little bit more time to dig through, but if you send it to me, I will commit to looking at it.
Thank you, everyone. Have a great night.
Thank you.
Thank you.
Bye.
Bye.
Bye.